Hey, Tony, we're not hearing your audio.
Oh, well, I had a lot of good things to say while I was on mute, so I apologize.
You might want to
Let
start.
me back. Yeah, I'm not going to go all the way back to the front here. I'm going to just start right here. This is really the meat of the presentation. So, most financial advisors don't retire when they should, um, primarily because they don't want to and they're having fun with what they're doing. But that, to some degree, is a selfish reason because they may be losing touch with both the clients and the industry and not keeping up. So when we ask people about their retirement plans, most people say, well, I'm going to retire in about 5 years. And we tried to get a better understanding as to why people want to retire in 5 years. And what we've identified is that 5 years is not too far away, so you can see the light at the end of the tunnel, but yet it's not too close where you actually have to pull the trigger on retirement. So this seems to be the comfort zone for people. But what's scary is that the overwhelming majority of advisors, and even those that are less than 5 years from retirement, really don't have a succession plan. So if you look at this chart, you'll see that for advisors less than 5 years from retirement, 59% said that it's an unknown outside buyer that would likely purchase their practice. So they don't know who it is. They just know it's not someone inside their practice. 30% said it would go to a designated non-partner successor. So they know who it is, but it's not one of the partners in their firm. So probably someone outside of their practice. And again, these are people that are less than 5 years from retirement. There was a study done regarding the psychological reasons that prevent many people from planning. And the study was entitled Family Business, the Role of Goal Adjustment Capacities. And the study shows that business owners are often resistant to retirement. And so if you think about our practices, we're a small business owner, sometimes a family business. The number one reason is it's their inability to let go of their work goals. They want to hit that one more achievement, that one more goal. Even though it's probably unrealistic, they still want to shoot for it one more time. We also found, or the study found, that age does not correspond to readiness to retire. So someone who's 60 is no more or less prepared to retire than someone who's 65. And one of the big ones is that setting alternative goals is important for taking action in retirement. In other words, if you have nothing to retire to, then you don't want to retire because you have nothing to do. And number four, which is really important, is having trust in a successor. And one of our jobs in our advisor legacy process is to find the best person, the best fit for your practice that you're going to have trust and confidence in to take over your practice at retirement. So at this point, what I'd like to do is turn it over to Todd, and he's going to take you through the rest of today's presentation. And I apologize, I was on mute for the first 5 minutes or so, but you didn't miss a whole lot, so I'm going to turn it over to Todd.
Thank you, Tony, and thanks to all of you for joining us today. As Tony mentioned, many advisors tell us that they're planning to retire in the next 5 years, and in fact, a record number of transitions will happen in our industry over that time frame of approximately 5 to 7 years. For that group of advisors who are planning or hoping to retire in that time frame, the timing of their succession has become quite critical. And that's really the purpose of today's webinar, is to discuss what are some of the factors that might impact that timing. And the result of those factors is, for the majority of those advisors who are going to retire or hoping to in that time frame, that it's likely that the sooner that they monetize the equity in their practice, the better and the more successful the outcome will be. And that's really what the 5 reasons are about that we're going to walk through today. The slide that you see on the screen now is a pretty common consideration that advisors go through when they're thinking about the timing of their retirement. Unfortunately, this consideration is really oversimplified, and it has some problematic assumptions that go along with it. And the basic idea is that, if I continue working, continue making the same amount of revenue that I'm making today over the coming years, that I only need to work, 3 or 4 years to bring in the same amount of money that I would from selling my practice. So why retire, basically? Some of the problematic assumptions, the larger ones, are this thought process certainly doesn't take into account the expenses of the business. And generally, an average practice has expenses at around 40 to 50% of revenue, depending on the size of the practice. It also doesn't take into account the different tax treatments of the two different scenarios. One certainly being ordinary income and taxed at a high rate. The other one, the sale of the practice or the monetization of equity, is primarily taxed as capital gain. So there's a substantial difference there. Another assumption that's very clear in our own work in business valuations is that for most advisors who are in that group planning to retire in the next 7 years, their practices are shrinking. It's very rare that those practices are continuing to show growth. And as a result of that, both their revenue is decreasing as well as the value of the practice. A couple of other minor problematic assumptions are that practice value is often underestimated, and I would say that's especially true for those who haven't had a recent valuation or perhaps have never had a valuation on their practice. Usually they're pleasantly surprised at what it's worth today. And in fact, the average valuation is currently in excess of $1,600,000. As I mentioned, continued revenue is often overestimated, especially for those who are no longer actively marketing their practice. And then lastly, it's not a black and white issue where you have to sell the practice and immediately exit. There are a lot of blended exit strategies that people are following today, where they're monetizing the equity at the right time when it's at a high point, and choosing to stay on and continue servicing clients on behalf of the buyer, because as Tony pointed out, they're not really ready to retire yet. So let's get into the 5 reasons. Again, these really have a lot to do with the considerations of timing for that group that's going to exit in the next 7 years. And it's interesting, the previous 7 years, really up till the end of 2015, have been nearly a perfect environment for both succession and for practice equity, and those two things certainly go hand in hand. We had incredible growth in the industry, increases in recurring revenue, very high demand on the buyer side, and it really was a very strong seller's market. Based on the 5 reasons that we're going to go through today, we're going to anticipate a shift from that strong seller's market gradually into a buyer's market, and that's already starting. We basically saw the beginning of it in 2016, and it continues to increase in intensity today. It's widely believed that the previous slide is the primary reason that many advisors have delayed their retirement. They've been pretty comfortable. The market has been in record territory. Clients are satisfied. Advisors are making good revenue, and they really haven't had that pain point. And so many of them have stayed in the practice longer than perhaps they anticipated, and then also longer than maybe they should have in respect to the clients, receiving the best service possible. But, based on the 5 reasons that we're going to now walk through, you'll see that that group probably shouldn't continue to hold on, and there's a lot of potential risk in doing so. The first reason, and we've touched on this a bit, has to do with supply and demand. We've had again, a very strong seller's market. There's been a lot of buyers for each seller. But what we know about our industry, and really the country in general, is that the majority of practices are owned by the baby boomer generation, and those folks are either in their retirement years or getting very close to retiring. And it is the largest group in history of the United States who will transfer their business over that next 5 to 7 years. Our industry is no exception to that, certainly, except for there's been a little bit of a delay in the retirement. But there's also other factors that are compounding that issue. One of them being that we've done a fairly poor job at developing the next generation of advisors. And in fact, there are more advisors over the age of 70 than under the age of 30, as an example. So it's not really been a focus of the industry to bring on that next generation. And many broker dealers are investing in things like robo-advisors as opposed to people. And we're really going to reach a critical point where there's quite a few people selling and a relatively smaller number of people who are available to buy. And that's going to create a serious downward pressure on price. It's also going to make it harder to find that advisor or team who is the perfect fit for your practice and clients, because there simply won't be as many to choose from as there currently has been or there is today. And that will, that factor will simply increase over time. It was estimated in the United States that the year 2020 would be an all-time record for business transitions due to these trends of the baby boomer generation. And probably in our own industry, we're just a few years behind that curve. Maybe it's 2023, something like that, but certainly within that 5 to 7 year time frame. We really starting to move into that buyer's market at the beginning of 2016, and we're seeing an increase in that dynamic every year. The next reason has to do with practice equity and the fact that we've really been in record territory in respect to the equity, and the primary driver behind that has been practice growth. We were tracking very significant growth rates of 10 to 14% all the way through the end of 2015 due to several factors. One certainly being the strength of the market. Another major factor would be, retirement account rollovers. A lot of things. Again, it was almost the perfect scenario for practice growth, and that was the primary driver behind increases in equity. We've already seen a shift away from that. Current growth rates are only about half of what we were seeing in those times. And since we're also anticipating, some correction or shift in the market, it could become even worse where, that growth is declining in a more dramatic fashion. As I mentioned earlier, practices that are near retirement, being within 5 years, I would say, are rarely growing. The majority of those practices are seeing net asset outflows and annual decreases in revenue, and so those practices are losing value annually. The next reason is one that's not commonly tracked by most advisors, and that has to do with the cost of capital or lending for acquisitions in our industry. And in fact, most deals today are bank financed. It used to be the case, 6 or 7 years ago, where seller financing was the primary financing vehicle in the industry because there was no bank financing available at that time. But now we have lenders that specifically focus on our industry, and most of the deals that we see today are bank financed. I would argue that it's better for both parties to have bank financing because it allows the seller to monetize the equity at closing. For the buyer, they get a longer note of 10 years from the bank, which increases their earnings, and they don't have to come up with a cash down payment. The downside is it's certainly very interest rate sensitive, and again, over the last 7 years or so, we've enjoyed record low rates, which have resulted in higher prices being paid. And we've already seen an increase in that prime rate, which impacts the rates of lending. And that has a direct impact on a downward pressure on price, which we're starting to see already based on that funding. So there's another item that has already had an impact, will likely continue to, I think most people would say it's probably more likely that those rates will increase a bit rather than to go back down again. The next item is one that we found over the years is very close to home for advisors, and especially those who are solo practitioners who are not part of a larger team or have a larger practice with a lot of staff. And those advisors really have to wear all of the hats of a business owner as well as being the practitioner, that person serving the clients. And that has to do with the increase in both regulations and the technology required to run the practice. I mean, certainly we've seen a lot of compliance changes over the last few years, and we've seen a lot of changes in technology going to paperless office, having to use social media for marketing and so forth. And for most of the advisors, again, in that group who are going to retire in the next 7 years, they simply didn't start out with those things at all. In fact, they're very new to them, and it's really difficult to keep up with. In fact, it's been one of those items that we hear quite frequently is that they just, can't keep up with it. They can't do all those things on their own. And it's, in one respect, it sort of feels like they're being forced out of the industry or forced into a larger team as a result of it. And it's certainly not going to go away. I think you could clearly make an argument that with the passage of time, the complexity only increases, it doesn't decrease. And certainly a move towards technology is going to only increase and not decrease. So another good reason that, maybe selling sooner than later, if you're having a hard time keeping up with those things, which many are, is the better way to go. And then the last of the 5 reasons has to do with the age of our clients. Certainly what we're seeing today is that as the majority of the practice owners are in the baby boomer generation, so are the majority of the clients, and especially those who control most of the assets in the country. The average age of the clients that we're currently tracking is 61 years for all clients, around 66 years for your high net worth or affluent clients. And many practices are reaching a tipping point in respect to their average age and the value of their practice. And that's really happens when your high net worth or affluent clients are near or at an average age of 70. At that point, it becomes very difficult for a buyer to assign any kind of a growth rate to that client group. And in fact, the more likely scenario is that they're withdrawing assets, clients are passing away and so forth. And so they're going to have a declining asset base and a subsequent declining revenue base along with it. It's another one of those areas that has a higher impact on solo practitioners, those who don't have younger associate advisors in their practice who are bringing in that next generation of clients, and especially difficult to find those who have assets. And so it's another thing that we can look at and say, it's very likely for those practices that every year their client age will increase, and every year it'll have a downward pressure on the equity in the practice. And so again, the sooner that they monetize that equity, the better off they'll be, and the more, more of the equity that they'll capture. So those are the 5 reasons. Again, it really focuses on the timing of a potential succession for those who are planning to retire in the next 7 years. And it's critically important. For most advisors, the equity in their practice is either their largest personal asset or certainly one of their larger personal assets. And on top of that, it's very critical that they find the best successor for their clients and their practice. And both of those things will be under stress in that time frame. It's likely that the equity will be declining for the majority of that group. And because there will be fewer buyers, it'll be more and more difficult to find the perfect buyer and the best successor for their clients. So the way that we look at a successful transition and really the definition of success is based on those factors. Is the seller confident that they've chosen the right successor? And the way that really that that's happened in a transition is what we refer to as the grocery store test. And that really refers to, after the practice has transitioned, the selling advisor is running into their clients, maybe it's a year, 2 to 5 years later, and the clients are thanking them for really choosing the best successor and that they're doing very well with the new advisor. That's really the ultimate test of success. And then if you've also gotten a good deal, good price and terms for the practice, then it really is a true success. And that's what we strive for in our own process of advisor legacy, where we help people sell practices. So I wanted to spend a few minutes just going over that process with you, so you get a better feel for what that looks like. We're a little bit unique in the industry in that we represent sellers in our process for transitioning practices. Other platforms are either agnostic to the buyer and the seller, they're more of a listing service and don't represent either, or they represent the buyer more often than not. We elected to represent sellers from the very start for the primary reason that most advisors will only sell one practice in their lifetime. They have no experience doing so. And it's extremely important for several reasons, that being the equity in the practice and the ongoing care of their clients. So the first thing that we do in this process is we have an initial consultation with the seller, discuss their goals, talk about how the process flows, the timing, and so forth. And then we'll collect a fair amount of information around the practice and put together a profile, which will be published on our Advisor Legacy website and platform. If the advisor is with one of our partner firms like Ameriprise or Raymond James, then only other advisors on that platform will see that practice listed for sale. So only an Ameriprise advisor can see an Ameriprise practice listed for sale. So once that profile is published, all of the registered buyers on the platform, on that same broker-dealer platform, will see that listing and have an opportunity to express interest in it. What we'll also do is we'll want to identify any other local candidates who may not be participating in our Advisor Legacy platform already and specifically invite them into the process. And so we'll get a list of names from the seller, perhaps some folks that they've already spoken with, which is pretty common. And we'll also reach out to the local field leadership of the broker-dealer and ask them for a list of qualified candidates. We really want to start out with the largest group possible because it gives us a greater opportunity and the seller a greater opportunity to find that person or team who's the perfect fit. Once the time frame for expressing interest has ended, we're going to do our vetting and review those candidates with the seller and take that fairly large group and narrow it down to about 10 or less who we're going to then invite to bid on the practice. When they're invited to bid, they'll have access to two different areas. One is a number of reports that are uploaded to the seller's profile, and the other is the deal terms that we're requesting. We will have worked with the seller to define those terms. So those prospective buyers will put in an offer. We don't ask for a specific sale price. And the reason that we do that is by not asking for a price, we collect a wider range of offers, and specifically, we use the upper range of offers to negotiate with the best candidates. Once the process of bidding has ended, then we'll do another round of vetting based on the fit and the offers and narrow the group down further to say 5 or less who we're going to take into an interview process. And that's probably the most important part of the overall process because it's where both parties get to determine, really do they have a good fit? Do their values align, client service models align, personalities align, and would they be a good candidate for your client service legacy? Usually in the interview process, and we conduct the interviews with both parties, really get a chance to ask some in-depth questions. The seller comes away either having selected someone, someone maybe really stood out as the best candidate, or they've narrowed it down to 1 or 2 leading contenders, and then we'll conduct further due diligence to differentiate between those, perhaps in-person visits with the team, additional calls and so forth, whatever it takes really to finally select a buyer. Once the buyer is selected, then we'll help with all of the final deal making. That's getting the bank financing in place, completing the formal legal agreements, which are done by our attorney, helping plan the actual transition of the clients, and one of our executive coaches will do that with you, and also working with the broker dealer to make sure all of their requirements are completed as well. That process takes approximately 4 months from start to finish, from the start to when the deal is closed and you receive the funding. And the way that we get paid for that service is based on a percentage of the sale price only on the successful sale of the practice. So there are no upfront fees. It's all contingent on the sale being completed and funded. As you can see on the bottom, the range of the success fee is 2 to 6% of the sale price, and is based on the size of the practice determined by the current 26 period or 12-month GDC. So that's our Advisor Legacy platform. Again, we represent the seller specifically, and we're really looking to make sure that you have the perfect fit for your clients, you receive a very strong deal in terms of price and terms, and that no mistakes are made, and you have very little risk in the deal. And all of that we've successfully completed many times. So with that, I'm going to hand it back over to Tony to close it up and take any questions that you have. Thank you.
Well, thank you, Todd. We've had quite a few people signed in here late to the webinar, so I'm going to go back and just talk about the 5 reasons why you might want to consider selling now, just real briefly. So number 1 is valuations or prices are at all-time highs. A lot of that has to do with the market value. And frankly, there's a lot of people who are really enjoying more income than they've ever had. And they're at an all-time high in the market, and now is the time to sell. And I would be careful that we might see some market corrections that could drive down that value. Secondly, is we still have more buyers than sellers, but those demographics are going to change. We're going to have a lot of people selling with fewer buyers. Third is interest rates are at historic lows. They're up a little bit off of the bottom, but most of these deals are financed, so it's important that you can get low interest rates to give you more purchasing power, or you can you can sell your practice for more because people have more purchasing power. Number 4 is technology and compliance is just getting more and more difficult. And then number 5, every year you wait, your client base is aging another year. So before I wrap up, I have a couple more things to cover with you, but I'm going to ask some polling questions of those who are in attendance. So this is the part where you get to participate. So let me ask a couple of questions here, and I'd like you to please select the best answer. All right, so here's your first question. Have you valued your business in the last 12 months? This is a simple yes or no. So if you could just mark the screen, or mark the answer on your screen, I'd appreciate it. I'm still waiting on a couple people to vote. Well, I'm going to close it off. So here's the results. Half of you have received a valuation in the past 12 months, and half of you haven't. All right, so let me ask the next question then. Do you currently have a continuity plan for death and disability, a written continuity plan that's at the corporate office and fully executable? Waiting on a couple more. All right, not going to make you guys wait. Oh, 100% do. Fantastic. This is pretty uncommon. Normally it's about 50%. So we've got some great people on today's webinar. And then finally, when do you plan to retire? 0 to 2, 2 to 4, 4+ years. All right, now it's a mixed bag here. We got half of you in the next 2 years and half of you 4+ years. Well, that's helpful information, and hopefully it's helpful for you to see your own answers compared to your peers. So if you're within 5 years of retirement, and that's half of you, we would recommend that you get a valuation on your practice to find out what it's worth. Some of you have had that valuation done in the last 12 months, but if you haven't, we'd certainly recommend that. And then schedule a free 30-minute consultation with us to discuss your financial planning needs. Now, our valuations are steeply discounted for our partner firms, which is Ameriprise, Cetera, Northwestern Mutual, and Raymond James. You get a $400 discount. So our street price is $12.95 and you pay $8.95. Our process is very turnkey and easy. Once you place your order online, you get a confirmation email, you answer a few questions, attach a few reports, and we'll turn your business valuation around in 7 to 10 days. We use two different methodologies. We do a market value analysis and an earnings-based analysis. And then we average the two to come up with what we think the fair market price is. But probably most important is you get a 60-minute consultation with Todd to review the valuation and see what things you can do to improve the value, or to talk about anything succession related or your desire to sell your practice. So to order a valuation, you can go to our website at keymanagementgrp.com, and then under services, you're going to see assess your practice. And then to the right, you're going to see a business valuation. And if you click on those, it'll take you to the business valuation page. You'll see three different options. One for our partner firms. I think everybody on today's webinar is with one of those broker dealers. So you select that for the $8.95. And then people who are not a partner firm can also order for $12.95, and then banks can order on that page as well. But you're going to want to go to the partner firm valuation. So what I'd like to do is open it up to some questions. So I am going to give you a few seconds here to either raise your hand, and then I'll unmute your telephone line, or you can type in a question and I'll read it off and we'll do our best to answer. And again, you do that by going to the GoToWebinar control panel. Well, Todd, it doesn't look like we have any questions today, so I want to thank all of our viewers for joining us today for today's presentation on 5 reasons why you should consider selling now. We would be happy to talk to you for a one-on-one consultation. You can get a hold of us in a bunch of different ways. Todd's direct information is the bottom right-hand corner of your screen. You see our 800 number, and then you see our website. If you want to get started on the valuation, just go to the site, place your order, and you'll get instructions on next steps. But it's a very simple process. So thanks, everyone, and have a great day.